Okay, everybody, time to begin our session. The countdown just reached 0, so it's time to start. Before we begin, would you mind to confirm to me that you hear my voice, that everything is good to get started? Please type on the chat box, on the comment box, depending if you're using YouTube, Facebook, or iZone. Go ahead, please, and type a quick yes, a quick hello, something like that, so I know that you hear me. I believe we should be fine. But just in case, it would be good to confirm before we start, just to avoid me talking to myself, okay? Anyway, so I'll just wait for your confirmations here. Okay, good. Wonderful. Wonderful, wonderful, perfect. So let's get started. Welcome to the session, my dear UFO traders friends. Today is March 7, 2019. We are ready to get started. Our session today, our get-together session today, is about longer-term trading. And I'm excited today because we've been spending a few weekends now, a few Sundays, doing sharpening. And I feel that more and more we are speaking the same language of options when we do longer-term trading. And in that sense, I am happy because our sessions are little by little going to become more efficient, more straight to the point, more about finding trades and execution, and less time spent explaining things, because those things are being explained over those weekend sessions when we do sharpening. I believe that probably most of you, hopefully all of you, are aware of our sharpening sessions. Just in case, in our website here, as you can see on the right side of my screen, there is the Get Together button. Okay, this especially applies if you are watching this recorded, obviously. If you are live with me, you know this. And in here, you can see the calendar of sessions, and those sessions that are marked as sharpening, those are the sessions I'm referring to, okay? So again, we've been spending a few weekends now talking about options, and we'll be taking these things little by little to the next level. The key word, okay, is the word rules, okay? To be a good trader means you have good rules. Of course, then you have to follow them with discipline, but everything starts with having rules, and those rules to be good, right? So, and to be able to have rules, you also need to have the knowledge. So your rules are actually aligned with how the markets work, okay? So that's why I was saying a minute ago, I'm excited, because at this moment in time, what I could say, based on what we covered, is that everybody should be able to know how to construct an options trade where you either buy a call or you either buy a put, which is a simple application of options, but it's very powerful, even though it's simple. So we're going to exploit that to a deeper level today and look at multiple trading opportunities, okay? And also today, I would like to start the day a little differently that I would normally start. Well, actually, let me get rid of the disclaimer, right? This is the way I always start, so that I will not be able to avoid it. So anyone would like to count? Anyone would like to just to time how long I'm going to do it this time? Let's go for it. Disclaimer: the following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Here we go. Hey, it was not bad, isn't it? I did it pretty well. So anyway, ready to start the session, and I was saying that I was going to start slightly differently today, and the reason why is because I have a little announcement to make here. You guys are gonna get excited, especially if you live in the UK, especially if you are in the London region. You're going to get excited because there is a group of traders that are getting organized there, a group of UFO traders that are getting organized. And the idea is to meet from time to time, let's call it once a month, and get together physically in person and discuss UFO trading and take things to the next level. Okay, so what I'm going to share on the screen right now is an email in case you are interested in participating of those sessions that will take place physically in a venue to be defined in London City, go ahead and send an email with your contact information to londonufos@hotmail.com, which is the email of one of the local UFO traders in London, and you guys can get organized. Okay, so I'm just sharing this information for you guys locally if you are in London to organize. Okay. Good. Exciting, guys, not only to see the community is growing, but on top of that, that you guys are working as a team. It's a little bit of an alien invasion, isn't it? Anyway, long life to UFOs. Here we go. So another thing I would like to do, as well as we start the session today, is to share an email. Okay, to share an email that I have received. I mean, we receive emails in a regular basis, but this email is being received today, and not only is relevant because the email has been received today. The other reason why the email is relevant, it's because it refers to a trade that we could really plan now to be executed when the market opens 25 minutes from now. So I think it would be a great idea to begin the session with the email. So that way we bring some support to the UFO trader who sent that email, Supply and Demand Trader. How are you, friend? I believe you are probably with us as well. Yes, Mark, it was fun, isn't it? Yeah, you guys don't see the email address on the screen. I thought I put it in there. Let me see if it will show up now. It should be able to show. Oh, you're right. Interestingly enough, it doesn't. For whatever reason, it doesn't show. Let me write it down again. Let me write it down again and see if this is going to work this time. I don't know why it didn't show on the stream. Normally it would. Now I believe it's showing on the stream now. Yeah, I think it does. I think it does. Good. So perfect. If it doesn't show, London Trader, I see your comment there. If it doesn't show, let me know. I believe it's showing now. Yes, it is. Okay, perfect. Good. So anyway, back to the email. We have an email from Supply and Demand Trader, who I believe you are probably with us. So let's read the email, because this is the way to put an email together, guys. Because even our trader friend here, Supply and Demand Trader, also attached the picture of the chart, etc. So that way we can all understand properly what the plan of the trade is. Okay, so let's read everything here. So Jose, I thought that I just thought I would drop an email to let you know if it's really benefiting my trading. The speed I can go through different markets and identify supply and demand is really letting me keep my analysis to a minimum, put the trades on, and then live my life the reason we trade. Love it. Here's a potential trade I have identified overnight that I may take when the market opens, as I know Amgen currently has high volatility. It is for a credit option spread. Remember, credit option spreads, okay, this is a strategy that we have not covered yet during the sharpening sessions. We will very soon, but not yet. But basically, this is a type of application of options trading where we are doing non-directional trading. Okay, non-directional trading. So we are selling options, and when you sell, you get paid. That is why it's called a credit. So it's a credit option spread that expires on the 22nd of March on Amgen. Supply and Demand Trader didn't see enough credit on the trade, even though I would guess that Supply and Demand Trader is happy with the UFOs available on the chart at this moment in time, but the credit is not enough. So we will need to look for a solution for that, see if possible. And the earnings are not happening until April 24. We are March 2nd, so really, we have dates for us to play with. Okay, so we'll do that. Yes, good to see you, Supply and Demand Trader. I see you now here with us. Wonderful. Thanks for sending this email. I don't know if you were with us at the very beginning of the session or not, but that's the way to do it. I was making very positive comments about your email, in the sense that this is the way to send a question, with the screenshots and everything, so we can all fully understand what you're thinking. I am thinking about taking it in one of the two ways: a single credit spread below the second 60-minute UFO demand level. So in other words, this is the first UFO, and this one right here, the second UFO. So a credit spread using that second UFO, or maybe instead of doing a credit spread, the consideration is to do an Aaron condor, okay, which basically is two spreads, one with the puts, one with the calls. And that would be beyond the second UFO with buy orders, okay, which is demand, or above the second UFO, which is sell orders, which is also known as supply. So we have two red UFOs above, two green UFOs below, and the question is to either plan an Iron Condor or plan on a credit spread. That's the idea. That's the question, okay? And I can also see, let me zoom in a little bit here. Okay, I can also see that you are attaching here your trade. So when it comes to the call side, okay, and this is a lot of information here on the screen, guys, but just focus on what matters, okay? On the call side, supply and demand trader is using 192.5, 197.5, you know, $5 strike price increment here. And on the put side, right here, so supply and demand trader is using the 175, 167.5, which in this case, we have $7.5 of strike price increments, which makes a lot of sense because we are nearer. When you look at the screenshot, you can see clearly that the current price, okay, the current price, which is right here, it's nearer distance-wise to the second UFO. So if I was to draw, you know, a line, and that line was to represent the distance, right? So the distance between the two arrows is less compared to the arrow on the top. Okay, if I was to measure from here to the arrow on the top, as you can see, the distance is more. So because we are a little bit lower in the range, we're not totally centered. You know, that's why you ended up here with 7.5 strikes below, and sorry, $7.5 below when it comes to strike differences, and $5 above when it comes to the strike price difference. So, you know, your plan here makes sense, but of course, to really have a proper understanding of this, we're gonna have to simulate this trade real time with a simulator and see what we have. Okay. At the end, you say here, thanks for providing the tool. My pleasure. And mentoring 3 times a week, my pleasure. Yes, and I agree as well with your perception of value. Absolutely. Thanks for that. Anyway, so let's go ahead and take a look. The first thing I'm going to do here is to load Option Station Pro. And the reason why I want to do this quickly is because, you know, the market is going to open in 18 minutes from now, and the brokers normally reset the options chain anywhere between, you know, 15 to 30 minutes before the opens. It depends on the days, it depends on the brokers. So I may have the option chain on Amgen. I just typed the wrong symbol. Let me retype it again. Amgen. I may have the option chain you know, zeroed out at this moment in time. If that's the case, I'm going to have to wait for the market open, and then immediately we'll do the analysis, okay? Let me see what we have. Well, you know what? We have data, okay? So they haven't reset it yet. So let's do this quickly and see if we can do the analysis, because to be honest, you have done it very easy for me in the sense that you have already selected the price levels on the chart with the UFOs. I could certainly, and this is what's beautiful about when it comes to being a mechanical trader. You know, this is what's beautiful. So if you look at my UFOs, I got here 177.90, 176.35. And if I look at your UFOs, as long as you use the same calibration settings, you got 177.90, 176.35. So you have the same values. So you see, there's no room for subjectivity. We are mechanical. You know, we all have the same application of the methodology, which never happens when using other techniques on how to trade, where different traders may have different opinions or different interpretations of reality. In this case, we are not doing any interpretation of reality. The computer does it, and the computers are always mechanical. So that's very cool. So I'm going to make an exception. Normally, I would use my chart. I will not use my chart today. I'm just going to use your screenshot, because your screenshot is like my chart, and therefore I can save a little bit of time by doing so. Let me make it a little bigger so everybody sees well. And again, we have 192.12 is above. So let me type this information on our Option Station Pro. So we said 192.12. So 192.12. That's the information above. Let me do it again. 192.12. Here we go. And below it's 176.35. 176.35. Okay, so these would be the values. Okay, in the middle I got the last, on the top and the bottom I got the upper part and the lower part of the range. And now when it comes to options, I'm just going to start with what you suggested, which is March 22nd. I'm going to right click anywhere, analyze sell, an iron condor. Whoop, I just picked iron butterfly. And let me do it again. Right click anywhere, analyze sell, iron condor, not butterfly. And then I'm going to adjust the strikes the way you said. So I believe you were using the 175, 167.5. So that's going to be 167.5 and 175. And then on the upper part, you were using the 192.5 and the 197.5. So we're going to move to 197.5 and 192.5. Okay, and right now I got the same information on the screen that you have. And from there, we can start, reaching certain levels of conclusions. Okay, so the first thing that we can see here, is that if you were to reach the upper part, this condor would lose 99. If you were to reach the bottom part, this condor would lose 152. I'm going to have to say that I'm not too happy about this because you always want the lower part of a condor to lose a little more than the upper part of the condor. That's okay, because when the markets fall, they normally fall more aggressively. Options gain value faster, and therefore you may get a little extra pain in the bottom part of the condor just because of how options are priced. But at the same time here, a little more, it's actually 50% more than what you have above, right? So if let's call it above 100, 50% of 100 is 50. That's what you got below. You got 150. So really, the difference would be too great. Which I'm not saying we will not. It's not okay to take it, and maybe it had to be this way because, as you can see with Amgen, if you look at the option chain, the strike price increments are of $2.5 at the time. And therefore, we may not be able to adjust this in a better way. That's sometimes is what it is, and you have to take it or you have to pass. Is that making sense? But I would like to give it a try to see if we can maybe fine-tune a little better. And then also would like to look at different expiration dates and see potentially which condor is the one that represents the most intelligent pick, if you wish, when it comes to maximizing the probability of profitability. Okay, so let's take a look. Okay, let's take a look at this. Okay, and let's see how we're gonna do this. Okay, so what I'm gonna do first is I'm gonna get into my chart, and even though I said I wouldn't, I will, because one thing I don't see on your screenshot is the pre-market and the post-market data, and you have seen that before. Okay, you have seen that before, where sometimes pre-market data is not relevant, and sometimes pre-market data or post-market data is actually very relevant. And how do you know that? Because every stock is different. You know that thanks to the metric, the 52% here. That number will tell you if it's relevant or not. So if I select US stock with pre and post-market data, and we look at that 52.36, and I click, and now that 52 becomes 45, what is it telling you? Well, it's telling you that pre-market and post-market data, it's a waste of time. Okay, for that stock, it's not relevant. Sometimes, okay, and if you have been with us here in the room in other sessions, you have seen it that sometimes we'll deal with stocks where the pre-market and post-market data actually provides more powerful metrics, and therefore it is relevant. But in this case, it's not. Therefore, I would 100% agree with your chart, supply and demand trader. And by the way, I know you are not at all a trader in learning stages. You are a very advanced market professional, but at the same time, I always like to do this double check because sometimes we could forget. So it seems good to use that 136 and 192.12. It seems really good to use this as our top and the bottom of our range where we expect Amgen to remain for a while because this is a non-directional trade. Now, again, I would like to try to adjust those parameters a little better. Okay, I would like to try to adjust those parameters just a little better. And by the way, notice how I got all my figures here now to become 0. So here we go. We can see now the option chain has just been reset. Okay, so it's 10 minutes before the open. They just reset, the option chain, and therefore I'm gonna have to pause this analysis until 10 minutes later, because if I do it now, it's gonna be purely theoretical, which I could do it theoretically as well, but I would rather see the real prices with the real bid and the real ask, because those would be more representative of the real market condition. Okay, so again, know that 10 minutes before the open, markets normally, brokers normally reset those options chain, and we just need to wait 10 minutes. Okay, so what are we gonna do with the next 10 minutes while we are waiting for this to happen? Well, we're gonna start talking about the next trades that we're gonna take, and we're gonna start getting ready for it. If you remember, and I'm fully aware today, I'm speaking at a pretty elevated speed because today I'm less, if you wish, a little less open to spend time adding details and explanation to what I do, because I did a lot of details during the sharpening session. So my intention is to go straight to the point, even though I'll share a lot of thoughts and a lot of detail, but less than other sessions. Okay, guys, I want to make sure that we find a bunch of trading opportunities. Okay, that's the priority. And again, when we are back on Sunday, I'll take it easy, and probably I'll still speak fast because that's me, I guess. But at the same time, I'll be a little more detailed with the explanations. Having said that, if you have any question as I'm planning the trades, make sure we don't go home with those questions unanswered. Okay, please type it, and I'm going to be looking at your questions all the time, and I'll be providing you with those answers. Okay, so these are the notes. These are some of the notes that we got from the sharpening sessions. And as you can see with the notes that we have here, what we learned to this point is to buy calls, and what we learned to this point is to buy puts. We have learned many more things, but when it comes to how to do it, I'm not talking about generic knowledge or knowing what's an option or what's an expiration date. I'm talking about how to plan a trade and how to execute a trade. What we know, what I could say, have explained, to the fullest extent, if you wish, it's how to buy a call and how to buy a put. That's where we are at this moment in time. You have seen supply and demand trader. He's an advanced trader, and he's planning on spreads. Okay, and we'll talk about spreads, and believe me, it's going to be very soon. Okay, but what we know, okay, what I know that we all know at this point, because I have explained it, is how to buy a call and how to buy a put. And you probably remember as well that buying a call makes you bullish, so you profit from a rising market, and buying puts makes you bearish, so you profit from a falling market. That's what this does. So what I would like to do, apart from getting back to supply and demand trader trade with Amgen, once the market opens a few minutes from now, what I would like to do is begin the preparation of my scanner. Okay, begin the preparation of my scanner in a way where we're going to be scanning for stocks that are ready to be bought in a good condition. Okay, and as we spend more and more time together, everything is going to get more advanced. So what I'm going to do with that particular scan, the US stocks, okay, I want to copy that scan. Okay, I want to copy the scan and paste it. Okay, and now I have a copy of that scan, and now I'm gonna format it. Okay, I'm gonna format it. I'm gonna give it a different name because now I'm gonna be a little more purposeful with the name I give it. You know what? I should have given it the name earlier. I believe rename scan here. So I'm gonna call it long stocks. Okay, so I'm gonna redesign the scan. to find opportunities to go long stocks. I'm going to do it in a way that is more advanced than what we have up to now. What we have up to now, if you look at the scan criteria that we have on our list here, so we were looking at stocks above $50 a share. Maybe it would be useful if I zoom in a little bit here, guys. So what we have, okay. Give me a second here. It's not allowing me to zoom in. Let me see if I can do it, because when I use the combination of keys I should be using to zoom, yeah, I cannot do it because TradeStation has, I need to press an F key, and TradeStation uses it here, so it's not allowing me to zoom in. So anyway, maybe you could zoom in on your computer screen. So what we have here is a stock which is currently, we want stocks that are currently above $50 per share. We could certainly look for options opportunities with cheaper stocks, okay? But at the same time, when the stock becomes too cheap, the problem of stocks that are too cheap is that the options become too cheap as well. And basically, it's kind of like, it's not even worth it to use options anymore if you trade stocks that are $5 a share. Okay, so now when you do non-directional trading, though, this condition is very, very important, because you're going to be selling options, and if the stock is very cheap, you will only get a few cents. Why? Because the stock is very cheap. So when you do non-directional trading, the price of the stock is very important. When you do directional trading, which is what I'm planning to do now, which is long stocks, then this parameter is still important, but less. Okay, so because it's less important, I'm going to go ahead and I'm going to drop this figure all the way to $15 per share. Okay, 15. Oh, I got one extra 5 here. Okay, 15. Here we go. So $15 a share. This also allows you, if you never traded options before, or you want to learn options and you want to take it easy, so you can really use very little amount of money per trade. Or if you were to trade options and your account was to be a limited account in size, because you have limited capital, or just because you want to start with little, well then, with this condition of going from 50 to 15, now we're going to be able to find more stock opportunities. Second, you probably remember here that we had a condition, we have used that before, with 2 moving averages applied to a daily time frame. The 21 moving average applied to the daily time frame, the 34 moving average applied to the daily time frame, and if the 21 is below the 34, that means it's a downtrend. If the 21 is above the 34, then it means it's an uptrend, because the average price movement is going up. Okay, so I'm looking for stocks in an uptrend, and this is not new. We have done this before, but I want to add one more condition based on moving averages. Okay, so I'm going to come in here. I want to add one more. So indicators. Okay, indicators, and we're gonna go for moving average one line. Okay, we're gonna look at we're gonna look at this guy here, and we are gonna make it to be greater of or equal than another moving average. Okay, so we're going to be using two more moving averages in this scan, and you will see why. And the one above, we made it greater than, so the 21 moving average is above the 34, so we're in an uptrend. But now what I'm going to do is I'm going to use shorter moving averages. I'm going to use the 5, okay, and I'm going to use the 8. And what we will want is, I will want the 5 to be below the 8. What does that mean? That in a very, very short term, the average price movement is going down, while in a little bit of a longer term, the average price movement is going up. So basically what I'm looking for stocks that are in an uptrend, but they are not moving up at this moment in time. They are retracing, moving down. In other words, approaching green UFOs, as long as there are green UFOs on the screen. Okay, so I'm adding one more condition here that will make it very useful for me. And then we have the DMI, which you want it to be greater than 25. Okay, you want it to be greater than 25, and that means that the stocks are trending. So they are trending down because remember we selected 21 is below 34. Sorry, they're trending up because 21 is above 34, but the trend is strong. That where the ADX to be greater than 25 means, right? And on top of that, we are looking at options, which are the 50 cheapest options in the market. So the bottom 50, implied volatility, bottom 50, and then we are looking for 100,000 contracts of open interest, which means liquid options. There is one more condition I'm going to add. I told you I was going to make this scan to be more sophisticated. I'm also going to add a condition based on the commodity, the RSI. And we'll do a session to talk about those indicators in case you're not familiar with them. And we're going to be looking at values of RSI. RSI basically means relative strength. So it's an indicator that measures the stock against the stock when it comes to its strength. And, this gives measurements going from 0 to 100. And there is a school of thought that suggests that if that particular value of RSI is anywhere between 40 to 60, it means the stock is trending and the stock is not overbought and the stock is not oversold. Okay, so in other words, there is room for the stock to move up, right? And so anywhere between 40 to 60 would be acceptable, right? And what I'm going to do now is run the scan, and whatever we come up with, okay, that's going to be a list of stocks that we're going to use for us to buy calls on them, because those will be valid stocks to go long. So we'll be planning on call trades. While the scanner do its job, and processes all this information, which is a lot, because you have seen I added a lot of things there, okay, just to have a proper filtering. And by the way, here's one risk I'm running here. When you add too many conditions, okay, there may be days where you get no market opportunity or very few because you're being very picky, okay? Another way to say picky is you're looking for high probability, okay? So I'll welcome being picky. And if the result is disappointing because I got very few stocks, then I will change a little bit the conditions to make myself a little more flexible, and hopefully I'll find some opportunities. And if I don't, it means it's no time to trade that day. Okay, and we'll have to be respectful of that fact, because we are not Goldman Sachs. We don't have the power to produce opportunities. So what we need to do is to be disciplined and smart in a way to respect the opportunities if they are found, and ignore the opportunities if they are not found. In other words, don't make up opportunities that don't exist. Now, while the scanner is running, back to the option chain, because that particular stock just started trading again. So all market data is now reactivated. Right? Where is that stock trading at, by the way? So that stock opened basically at the same price where it was when it closed yesterday. So it's down by 0.08, 0.14, so more or less at the same price. And notice how nice this is. And I have to say, supply and demand trader, that obviously you have proven that you are an experienced trader, because these results that we have in front of us were not looking like that earlier. Remember when I was pointing at in the bottom part is looking like you're going to lose 150, on the top part is looking like you're going to lose 100. Well, notice what happens now. It's very well equalized. Okay, and why is that? I would guess, and please confirm if this is the case, but I would guess that probably what happened is that when you did the plan for this trade, you did it during market hours, and these options had okay spreads, where when I did it 10 minutes or 15 minutes before the open, those options were lacking a lot of liquidity, and therefore the prices the computer had to calculate and simulate this trade were distorted prices, and therefore we saw this huge difference between the top and the bottom. But you have done a good job. I mean, this trade makes sense from the point of view of adjustment, and I would even say risk versus reward. If you do this trade at market price, you're going to get $86. But if you really look deeper into that, the bid price is 2 or 3. the ask price is 85. If you were to bid, if you were to ask for the midpoint, 145, let's say you get filled at 150, sorry, at 130 or something like that, well, you are getting paid 130 for you to risk 130. It's kind of like a one-to-one. And a one-to-one type of trade normally is never too appreciated in the world of directional trading. But in the world of non-directional trading, because you have the time decay element that reduces the risk of the trade every day just because time passes, that could be a valid trade. Okay, that could be a valid trade. Okay, the question really is, what's your probability of being stopped out? Okay, so do you have a high probability of being stopped out? You don't have a high probability of being stopped out because, again, let's say you didn't have UFOs on the screen, right? If you didn't have UFOs on the screen at all, okay, and remember, what you want to avoid is that this market reaches the bottom part of the chart where I got the yellow circle. You would like to avoid this to happen, correct? Well, if you didn't have the green UFOs, definitely, you would be hoping too much. Given the fact that you have two green UFOs to the self, you are likely to collect some bounces out of those UFOs, and therefore accumulate, say that the trade makes sense that you have yourself. Now, my concern, which I believe the way you phrase your email, I'm kind of reading between lines, and I believe is your concern as well. Firm if I'm right or wrong, but your concern is more with the expiration date. It's not about the UFOs, it's more about expiration date that is too far or too close. Probably your concern is more more of that type of concern. Okay. Let me see. I have a question here from Mario. Let me get that in the main screen. So Mario says, I will say, to be sure to have the risk of 130, how should we place the stop? Yes. So for you to have the risk of 130, your stop would need to be located. Your stop would need to be located where we have the values with the red dot. Okay. Those values here, 176.35 or 192.12. This is where the stop should be located, and you should kill that condor manually at those prices to be able to experience those particular P&L metrics. Okay. Now, again, this is assuming that you're gonna get that, because if you do what I said and you take it easy when it comes to executing the trade, and you go for 130 and you get 130, well, now look at what happens. If you get paid 130 to do the trade and you get stopped out, you lose 67 or 77. Right, which is much better than a one-to-one. But it's even better than that. Every day time passes, that would diminish by $3 every day, and faster tomorrow, and faster tomorrow, and faster tomorrow, because of the time decay behavior. Okay, which it's less at the beginning and is faster as time passes. So this trade could make sense. So the real question, and I believe is probably the concern of supply and demand trader, is, okay, so is March 22nd a good idea? Is it the right expiration date, right? And this is where we need to get a little more advanced with the use of the iron condors. Mark is with us today as well, isn't it? Yes, Mark. Yes. So Mark sent me an email the other day, and I will not share much detail about it, Mark, but only what's useful, if you wish, when it comes to supporting you guys as traders, because of course 100% respect for when you guys send emails that have to do with some of your specific trades, unless you want to share yourself. But my point, and that was a great conversation with Mark, is that we were discussing that you could use an iron condor in different ways. So one basic application of iron condors is to go ahead, do the analysis of your chart, concluded that you have UFOs above and below, understand that it's unlikely that price reaches this level on the chart, and it's unlikely that the market reaches this level on the chart, and therefore you just construct an iron condor, expecting that whatever happened, that stock is going to remain between the range from now until the expiration date, and therefore on the expiration date the options have expired, and therefore whatever you collected is kept as yours. That's one way to do it. In that scenario, of course, you could be wrong, you could be right, you could be wrong. So if you were to be wrong and you didn't expect the market to reach that level or reach that level, what could you do? Well, use a stop. And the answer to your question, Mario, was the stop should be located where the blue lines are. The stop should be located exactly where the UFO, because if you were to have the stop beyond that, basically it means that beyond that you're hoping it's going to come back, even though you got nothing to make price come back because you have no UFOs beyond that, right? So you know, the plan that Supply and Demand Trader had for us is perfect. It's a good plan. Okay, and the way to treat it, option number one, will be to sell the condor, and if you reach to your stopping points, just get out, done. But what's another way to treat the condor? Well, another way to treat the condor is to not to use stops. Okay, you could treat the condor without stops. Why? Because, and I'm not saying this is my favorite choice, but I want you to understand the pros and the cons. Okay, so take a look at the strikes. 175 to 167.5. That is $7.5 difference. And then here below we have, above, we have 192, 197.5, which is $5 strike price increments. So what is greater, 5 or 7.5? 7.5 is greater. Okay, 7.5 in the world of options, everything is times 100. So that's 750. So what's the most you can lose if you didn't use stops? 750. But for you to lose 750, you will get paid 110. So you lose 750 minus 110 that you would get paid. So what's the most you can lose? 640. But if you were to close your eyes and do nothing, this is a trade where you're gonna make you'll make 110 or you lose 640. Okay, and that would be you close your eyes and you don't use stops. So option number one, use stops. That makes the risk to be less. Option number two, don't use stops. Why? Because here's what happens. If you use stops, what could happen is unlikely because of the UFOs, but it could happen, is that once you surpass your stops, either above or below, it could happen, let's say it's below, you know, it bounced, and finally it went through. It could happen later in time, it goes up, right? So if you had a stop at this level, you've been taken out. And even though it came back and you could be in a profitable situation, you never benefited from that because you were taken out of the trade at this place in this place in the chart. So if you were not to use stops and that market was to go down and back up, or was to go up and then back down, you would still be in the game. You have never been stopped out. Okay, and that's the beauty. What's the downside? Well, the downside is that you could lose 640, and for you to lose 640, you're gonna make 110. In other words, this trade is a 0.2 to 1, quite terrible. Okay, so what is a better way to do it? Okay, well, a better way to do it if you're gonna use no stops. Okay, a better way to do it if you're gonna use no stops would be to use spreads against your iron condor. So, and we'll need to do lessons on that. I just want to open your eyes because, you know, some of us have about it, have been talking about these things a little bit over the email. So I want to clarify this, but we'll do a proper lessons on that. But for example, if the market reaches this particular level, now you could buy a spread and construct it in a particular way. And this way, if the market keeps going and going and going and going, yes, you will lose 140. You will lose 640 because you never use stops. But apart from losing 640, you made a profit on the spread you bought. Okay. And that would offset most of the problem, and you may end up with a loss which is much less than those figures, while you give yourself the opportunity to have the market come back into the range and end up with a profit. So these things. I mean, options give you options. It's so cool. But let's keep going. So to validate this trade, what I want to do is to I want to start getting a little bit into using here on the right. I would like to start using a little bit these custom dates to do specific simulations. Okay, specific simulations. Let me see that. Yeah, specific simulations for us. Okay, so for example, here today. Today is what? Today is March 7. So let's come here to March 7, which is Thursday, and the expiration date of this option is March 22nd. March 22nd, right? Yes. So what do we have? Well, if we run this simulation, and this is not a mystery, we are going to be losing 100 above or 105 below. That's what the simulation suggests. Okay, probably what's been happening is that stock has been moving, right? And because the stock has been moving, options are inflating, and therefore, you could get in this trade. So 99 and 104, that's what you have. But the question here is, okay, what if, okay, leaving that 3.7 in the same place, okay? Notice that what the simulation tells you is that you could actually lose 95. Okay. Now, if instead of on 3/22nd, okay, instead of 3/22nd, you were to be stopped out on let's say 3/12. So what happens? Notice now that because of the time decay effect, you would lose 76 or 84. What if you were stopped out on 3/15? Well, now you will lose 61 or you will lose 68. What if you were to be stopped out on the 20? Well, if you were stopped out on the 20, you would still have some risk on the trade. You had $13 of risk still on the trade. What if you were to be stopped out on the 21st? Well, now, no matter what, you make $34 or you make 13. That's the time decay. But what's the issue? And that's why I was not too happy as I was observing this trade, and I could kind of read between the lines that you had a little bit of concern as well, supply and demand trader. The reason why is because it would take to remove the risk of the trade fully based on time decay and time passing. It would take for you to stay in the range all the way to 1 day prior to expiration. In other words, for you really to lock on a great profit in this trade, you have to stay in the trade for a very, very long time. So I'm not super in love with this trade because of that reason. It's a trade that would make sense for sure. The parameters are not, how do I put it? The parameters are within certain acceptable outcomes. So 111, and you're gonna lose 98 or 100. Okay, and especially if I go for the mid and I make 154, right? I do 154, right? So now I'm gonna lose 59 or 57. That's acceptable. Okay, that's acceptable. It's kind of like a 3-to-1. Okay, this push down of the market has inflated the options. You have a much better trade now than before, as long as you get the mid price. Let's say you don't get the mid price and you get, I don't know, let's say you get, 130, as I did before, which is that one you should get filled quite easily. So you are risking 80 to make 130. It's a 2-to-1, a little less than a 2-to-1, but it's okay, right? What if you get stopped out next Monday on the 11th? Okay, you would still lose 64. What if you get stopped out next Thursday, 1 week later? You still lose 49.50. What if you get stopped out the Monday after, which is on the 18th? Okay, 16.20. What if you get stopped out on the 19th? Now you still got $8 of risk. So now this little extra premium you collected allow you to be out of risk on the Wednesday of the expiration week. So again, normally I would like to have that. I would like to see that risk to be removed sooner, sooner, which means that I either should use a shorter expiration date or I should be using a wider range to be stopped out that soon. And that's the problem that we have. And earlier, when I was reading your email as well, when you said that the earnings reports are set as all the way in the middle of April, it sounded to me just a little too far in time, and probably those options didn't start increasing their pricing properly yet. So April 24 is the earnings. April 24 is right here. And notice how the level of inflation of options that you have here is 27, where the one you're using on the 22nd is 27 as well. So basically the effect of gaining premium because of the earnings report is not happening, and that's the reason why this trade is not the best trade of all trades. So that was a long answer, but I wanted to elaborate because you had such a well-presented question that I had to give some time to give you a proper answer, and I'm sure that everyone else is really appreciating your question and hopefully the answer too. But basically, you have a valid trade. You have a good entry point as well in the sense that you are in the UFO as we speak. You don't need to when you do non-directional trading, but it's even better when you do it. So you have a good trade in front of you, but unfortunately, I'm just a little concerned about little lack of premium in those options, which you mentioned that too in your email. Okay, so I would try to find another trade, and if any, you could take it. It's not a crazy one, but I would prefer to find another opportunity. Anyway, so in the meantime, while we were doing all of this, and please on the comments box, let me know how it went, because this was a little more advanced than normal, at least more advanced than prior sessions that we have done. I know that to some of you, this is piece of cake. You are very advanced, but remember, we are a mix of people in the room. Some of you have been trading options for a while, and some of you have never traded options yet. So I would be aware that for the newer traders in options, that was a little more advanced, okay? Yeah. Thank you so much, Supply and Demand Trader. Yeah, thanks for your comment. And again, super thank you for your question. I am super happy when I see you guys get serious about this business and you put time and the effort and you apply yourself. It's beautiful. So well done. Anyway, so now our scanner completed looking for long opportunities. Okay, and notice how even though the scanner was looking up to 50 opportunities, we ended up with only 7. Okay, only 7 opportunities meet with our rules, which is fantastic. You want a few. You only want a few. You want to be picky and have few. Why? Because that's going to be few opportunities with higher probability, better parameters, and therefore likely going to be a better trade. Okay, so let me start with BBBY. Okay, so what do we have with BBBY? Well, what we have with BBBY is a stock in an uptrend. Okay, the uptrend is actually strong. It's been in a downtrend for a while, but now, based on the parameters that we have added to the scanner, this stock is in an uptrend. Okay, unfortunately, I believe it's going to be difficult for us to find a valid trade with BBBY. I don't think I'm going to spend much time with BBBY. And the reason why is because we had a red UFO right on top of us. Let me see. Download scheduler. Yes, when you load a new stock and you are loading intraday data before you load a daily time frame, there are many times where it's useful to kill the download scheduler in TradeStation and reload the daily time frame and then go back to the 60-minute time frame. Normally it starts loading faster. Okay, yeah, so notice how we have red UFO in the 60-minute time frame above, pretty close, and also on the daily time frame right there. So basically, there is not much room for that stock to continue going higher. So even though the technical parameters were good, it's a little too late for us to try to join this trade. A different story is maybe a few days from now, this red UFO is taken out, and then maybe we'll have room to move, but not at the moment. What about Dell? So looking at Dell, what do we have with Dell? So again, little concern with those 2 UFOs on top of each other. So limited room for this to go. Now, look at the huge collection of green UFOs overlapping each other. Guys, this is, I mean, I don't want to sound too strong, and make sure you understand where I'm coming from. This is not a financial advice or anything like that. This is just purely an educational comment. But when I see this in my mind, it's almost free money. Okay, and let me explain what I mean by that, because this could be taken the very wrong way, and I don't mean it this way. Okay, but what I mean by that is that, look, let's say, okay, let's say, um, let's say that stock comes in here and you expect it to bounce, but it doesn't. Okay, well, now it comes in here, and if you expect it to bounce, but it doesn't, and now it comes in here and you expect it to bounce and it doesn't. I mean, one of those guys will finally bring this thing up. Is that making sense? So what's the beauty when you buy a call? Well, the beauty when you buy a call is that you could not use stops. And if that one fails, it's not like you have a stop below that stops you out, right? So you can give yourself a lot of room, a lot of flexibility for these to finally come back up. And of course, if many UFOs fail, then don't expect it to go to the moon. You may close it at break even, or you close it at 1-to-1 or something like that. You may not go for your final target, but certainly, even if that stock moves against you, the probability of it coming back and at least go above your entry point is very, very high. Problem: two red UFOs overlapping each other, which is going to be a lot of selling pressure with many sell-on field orders. So we're going to go for Mondelez, which is the next stock. And what do we have here? Well, here it does seem that we have something that could qualify as a setup. Okay, why? Because I don't see red UFOs anywhere close. What about the weekly time frame? Well, with the weekly time frame, it's a little more concerning. Yeah, the weekly time frame, it's actually producing some trouble. Yes, weekly time frame is producing some trouble because above 47.67, we got on field orders to sell. Okay, so it's a shame, guys. I was planning to drop to the 60-minute time frame, find a collection of UFOs, and get on board to ride this move. But we're gonna have to move to the next one, which is RHT, which is Red Hat. Okay, and that particular stock, back in November had a major gap, and it's in an uptrend, moving up. Two UFOs overlapping each other. All of this is great. Now that UFO is really bothering me, so let's go for the next one. SGMX. I just need to see a room. Is that making sense? I'm looking for a little bit of room for price to go. Okay, we have the UFO there, so we don't have the room. SQ. Okay, SQ. Here we go. No UFO. So now we have room. Okay, good. So SQ is giving us setup. Okay, we have an uptrend. Okay, we have a UFO here, a little further away from those two. I would prefer if we had this setup with the two UFOs overlapping each other, but it's okay. It's what we got. That's good enough. And then we have all this potential for room for this to go higher. So before we get too excited, let's look at the weekly. Nothing in the weekly. What about the monthly? Nothing in the monthly. So there is no red overhead. And if any, we'll have a little red on the 60-minute time frame. So if that's the case, let's see where that is. Okay, so here's the red I was talking about. Okay, we have red. Now, am I too concerned about this red? No, look at the number, 43. It seems that that stock is not heavily traded by institutions in this time frame. What about overnight? Same story. Okay, so the probability being below 50, that doesn't give me an edge. So I'm going to rely more strongly on the trend that what the 60-minute time frame UFOs will suggest, because it seems that that particular stock, SQ, Square Incorporated, it's not heavily traded during the intraday time frames, okay? Or at least it may be heavily traded, but institutions cancel their orders at the end of the day, okay? So what do we have? Well, we're going to be planning a trade on that stock. Just click on the wrong place. We're going to be looking at the options. We're going to be buying a call. Of course, we're going to be buying a call. Also, I'm going to be looking at the earnings date for SQ, okay, which is 1, 2, 3, May 29. Okay, that's the earnings date. So May 29, we're going to keep that information in our mind. Okay, here we go. So SQ. One second, guys. Okay, we have the option chain with SQ. And so the first thing, now that we have the options and everything here, so let's go ahead and plan. Let's go ahead and plan the trade. So the trade would be a trade where we would set a final target at 94.11. Maybe we can just be a little more conservative here because there is a lot of profit margin, so you don't want to miss the target. So 91.63. So 91.63 would be the final target. We could set up as well a safety target somewhere in the middle. Okay, that would imply the use of at least 2 options contracts instead of 1. And then our entry would be around the UFO, and our protective stop, which is optional stop. Okay, in this case, it's optional. Would be located at. Let me make those values to be blue. So it would be 70.23. So let's call it 70.20. Okay. So the entry, the top of the box is 73.28. So 73.28. And the safety target, we're going to calculate that in a second. Using our option simulation tool. Okay, so now, first of all, let's calculate the TTT. So remember, time to target. Okay, we need to calculate that. Okay, how do we calculate the time to target? Okay, well, we're gonna take how much room for movement we have, and the room for movement is calculated by looking at the distance from entry to target. This will be divided by the daily ATR, and then I will be multiplied times 7. Okay, and that will give you the TTT. Okay? So how do we do that? Well, we use a calculator. 91.63 minus 72.23. So that is $19.4. $19.4 is the room. It's the room for movement. This, we need to divide it by the daily ATR, which the daily ATR is currently 2.87. So do this divided by 2.87, that's 675. And now we're going to take this number and multiply times 7. So times 7, and that's going to tell us we need at least 47 days as an expiration date to be selected. Okay, so when looking at the option chain, 47 days is more or less here. Okay, April 18, April 26. But also remember, we also want to use the expiration dates lining up with the earnings reports, which happens to be May 29. So we'll get May 17. Okay, so that's going to be the nearest to the earnings report, and therefore in this trade we're going to be buying. Let me write it for you guys. We're going to be buying a call using a May 2019 expiration. That's the idea. Okay, now we don't buy the call now. Okay, because now the stock is trading at 73.90. Okay, we need to wait until the stock drops to 73.23, which may happen today, and then we buy the call. Okay, so little clarification just in case. I believe this probably was clear, but just in case, okay, or in case you're watching this recorded. So, so what are we gonna do? Well, select which call, and to select the call, we concluded that you want to buy a call that is not too expensive, not too cheap. So one way to do that was to look at the target price, 96.63, okay, and the entry price, which is 73.28, okay, and divide this by 2. 91.63 plus 73.23 divided by 2, that's 82.5. Okay, so 82.5, do we have this one? We don't have the 82.5, so then I'm gonna have to go for the 80 because we don't have the 82.5. So I'm gonna buy the 80. Okay, so we're gonna be buying the call, buying the 80 call. So the trade consists of buy the 80 call that expires in May 17, 2019. Was it May 17? Yes. Okay, that's what the trade consists of. And therefore, as we simulate the trade, we are going to be inputting those parameters on our analysis window here. So analyze by a single call. Okay, analyze by a single call. And we're going to have an entry point in blue. And then we're going to have target points in green. Okay, and of course you can use a stop optionally, but in this case I'm going to plan to not to use a stop, and you'll see why. Okay, so if I buy the 80 call and I buy it when the stock is trading at 73.23, that call is going to cost me $363.69. That's the simulation. Okay, so once the stock, wait a minute, let me do this again because I still had here the custom. I have the parameters ready. Yeah, so let me do that again. Once the stock reaches its entry point at 73.23, okay, the value of the option will be 364. Okay, so you are risking $365 of your money taking this trade, no matter how deep the stock goes against you. There is no way you can lose more than that. Okay, that's why one way to do this trade is to not to use stops, because even if you don't use stops, the much you can lose is limited. Okay, now of course some of you may say, okay, but I prefer to use stops. Fine, then you use a stop located around 70.20, right? I'll use the red one. So 70.20, that's your stop. The red is the stop. So 70.20, of course, this is gonna reduce. This is gonna reduce the pain, because now you buy the option at 365 and you sell it at 255, so you are losing $110. So the most you can lose is 110. Okay, but now if the stock comes back up, because it goes down, right? It goes down. Let's say this UFO fails, and now you gets here, you get stopped out, and then it keeps going, and when it gets there, reacts to it and keeps going higher, keeps going higher, keeps going higher, keeps going higher, gets to the target. Well, you never profited from that, because when it reached this point here, you got stopped out. So again, you decide how you want to do it, but specifically when trading stocks, look at the probability figure. Okay, if it was futures or Forex, okay, if it was futures or Forex, so what happens if I look at the S&P futures, at the S? What happens? 62%. What if I look at the stock, SQ? SQ. What happens? Okay, well, 49%. Why is that? Well, because obviously the way institutions place their orders in a small stock has nothing to do with how the institutions place orders on the biggest equity index market in the world, which is the S&P futures. Plus, that other market trades 24 hours, so institutions don't cancel the orders, where stocks trade only 6.5 hours per day, so institutions do cancel orders. So I guess you understand my preference, right? Not using stops in this case, it's a valid choice that we will improve in the future as we cover spreads, because if you were to do a spread, the same trade is not going to cost you 364, it may cost you 200. And now the most you can lose is 200. It's still more than 110, right? But it's less than 364. So we'll make this better in the future, just bear with me. But for now, this is going to be the plan. And the target is what? 91.63. So 91.63 is right here. And if you reach that point, notice how the option is going to become $1,464. And given the fact that you buy it at 365, so you're going to be making like $1,000 in this trade. So you're risking 365 to make 1,000. It's kind of a 3-to-1. It's okay. Makes sense. The trade makes sense. Okay. Now, we also said maybe you want to set a safety target. So where should you set the safety target? Well, a safety target means a safety target is a place on the chart where when you reach to produce a profit which is equal to your risk, and remember your risk is 365, right? So in other words, for me to make 365 through buying an option worth 365, that option should double its value to 730. So the question is, when is it that this number becomes 730? Because this number represents this price on the chart. So for this number to become 730, okay, I need to rise this price to, let's try 80 and see what happens. Now it's 680. What if it's 81? 735. What did I say? 730. Here we go. So what is my safety target? 81. 81. So let's say you buy 2 calls. Okay, let's say you buy 2 calls. When it gets to 81, sell 1, right? And you just made profit enough towards if now this stock goes all the way to become bankrupt and goes all the way to zero, you are not losing money anymore because the money you made with one of the calls offsets what you paid for the second call. So here we go, my friends. The trade is in front of you. So ready to take a screenshot. This is the time. Let me move this a little bit so you can have a little bit of a better capture of the screenshot, because this is the trade. And by the way, we're gonna have to call it a day because I surpassed by 12 minutes the ending time of the class. Okay, but anyway, this is fun. How is it going, my friends? Give me a little feedback on how it went today before we conclude the session. Yeah. Very good. Very nice, guys. Very, very nice. Nice to see you guys. And again, I understand, even though today in this session, I did feel that we were speaking much more the same language when it comes to options trading, thanks to the Sunday sharpening days, okay? Still, there were a couple of places in the session today that were a little more advanced than what I have been explaining during those Sunday sessions. So if it was a little too advanced, just bear with me and join me on Sunday. We'll keep advancing and you know, improving ourselves when it comes to trading and investing options. Okay, but you can also just keep in mind you can also going ahead and sending an email if you have any technical question. Okay, even though the best place where to ask is here. Okay, Mario, how to place the order? Very good question. Let's place the order before we go. So I'm just gonna show my order bar here. Look at the options one. Okay, it's already showing me the option I want to buy, which is the SQ call 80. But just in case, to avoid mistakes, I'm gonna go back to my option chain. Okay, and here I'm gonna right click. Okay, I don't know why it's not reacting here to right-clicking. Interesting. Okay, so I'll do it in the option chain itself. So right-click to copy the symbol. Okay, and once I copy the symbol, I will go back to my chart, and now I would just make sure the option symbol is there just by pasting it. I just hit Control V on my keyboard. Okay, so I'm gonna go with because I'm gonna use two options. I'm gonna have to do two orders. One is gonna be for the first call, where I'm gonna click advance and click activation rules. And look, let's do this. This is gonna be even more fun. Let's do it all in one order, guys. This is gonna be a little advanced, okay? But you know, it's okay. Sometimes if I challenge you just a little bit, you know, it's also because that way you learn better and more advanced stuff. Okay, so hopefully you're gonna be okay with this. Okay, so what are we gonna do here? Well, you'll see. I am copying those symbols. Let me do it again. Here we go. I'm copying the symbol here. Okay, and what I'm gonna do is buy to open one of the calls. Okay, so I'm buying to open the call 90. I'm doing it at a limit price, which is automatic. I'm just gonna split it, which is go for the mid price between the bid and the ask. Okay, but now I'm not gonna do that now. I'm gonna do it only if activation rule. And again, I'm doing this quickly because this is recorded, so you can go and watch. Okay, if this drops to 73.23, okay, then I'm gonna do it. So activation rule, if the stock drops to 73.23 or below, buy me the 80 call and split the price between the bid and the ask. And once I get filled, okay, once I get filled, and I would buy two. Once I get filled, okay, interesting. Oh, I just hit the horn, the wrong place, guys. Sorry for that. You know what happens that in my trading, I have all those type of orders set up as templates, and you kind of forget because you just fill in the template when you trade. So I forgot for a second the right button to click. So SQ 73. $73.23. So I'm just pushing it down. Okay, I should have just typed, but anyway. Here we go, 73.23. So if that particular stock reaches that level, so then sell to close. Okay, now I did it right. So sell to close. With a limit price, if you get to the target, and sell to close with a market price if you get to the stop. Okay, so what's the target? Well, the target is SQ reaches, what was the target? 91 something, right? The target was 91.63. So if it reaches 91.63, okay, just sell to close. And if it reaches 70.20, okay, if it reaches 70.20, SQ less than 70.20, okay, then get out with a market price, no time to think, you were wrong, get out of the trade. That is if you use stops, okay, if you use stops. But what is another way to do this? Another way to do this is this, okay, you have three trades. So you buy two of the options, okay, you buy two of the options. When it gets to the entry, your first target is sell to close with a split when you get to 81, which is the safety target, and you sell to close with a split, when you get to 91, what was it? 91.63. Okay, so take a look at this part on the chart. This is where you really see what I just did, right? So you have these activation rules: buy two, okay, buy two when you get in, and then sell one at a time. Oop, I just clicked the wrong place. Sell one at a time, right? One at a time. Now, even though it's one at a time, is different targets, 81 and 96.73. Okay, and now once you have that, you just place order. It's going to ask you for confirmation, and you click yes, right? And my friend, the order is in the system. You're waiting to buy two of those options with an activation rule. Okay, so that would be the way to do it, Mario. And again, super pleasure to conduct the session today, guys. We'll see you on Sunday. Okay, Sunday we do sharpening, guys. Be ready. It's gonna be fun. And beyond fun, very productive. So sharpening 9 a.m. US Eastern Time. Do the math if you're in a different time zone in the world. We always use Eastern Time because it's Wall Street, it's New York, so it's a good reference. So March 10, that's going to be Sunday. Let's get together, my friends, okay? Have a good week ahead. Still today and tomorrow for trading purposes. So, take advantage of those UFOs and kill it out there. Okay, we'll see you soon. Bye-bye. Take care, my friends.